What is the prime rate and how does it impact HELOCs? Imagine you're thinking about tapping into your home's equity to fund a big project or cover expenses. You might consider a home equity line of credit or HELOC. But have you ever wondered what influences the interest rates on these loans? Well, one key factor is something called the prime rate. The prime rate is an interest rate that banks and credit unions use as a starting point for setting rates on many loans, including HELOCs. It's the rate banks charge their most reliable customers, those with excellent credit. Usually, this rate is about 3 percentage points higher than the federal funds rate, which is set by the Federal Reserve. The federal funds rate is what banks charge each other for overnight loans, and it influences many other interest rates in the economy. Even though the Federal Reserve doesn't directly set the prime rate, it closely follows changes in the federal funds rate. When the Federal Reserve raises or lowers its target rate, banks usually adjust their prime rate within a few days. The Wall Street Journal publishes the prime rate, which most large U.S. banks follow. For banks and credit unions, the prime rate is like a foundation for pricing loans. When it comes to HELOCs, the interest rate is often expressed as the prime rate plus a fixed margin or spread. So, if the prime rate goes up, the interest rate on your HELOC will likely increase too. That means borrowing becomes more expensive. On the flip side, if the prime rate drops, your HELOC interest rate usually decreases, making borrowing cheaper. This movement in the prime rate impacts how much money banks earn from HELOCs and other variable rate loans. When the prime rate rises, banks earn more interest, which helps their profits. But it also means consumers might think twice before taking out a HELOC because the cost of borrowing increases. Conversely, lower prime rates can encourage more borrowing, leading to more loan applications and approvals. In the world of home and auto loans, the prime rate's influence is just as important. Many of these loans also have variable interest rates tied to the prime rate. So, when the prime rate changes, the monthly payments on these loans can go up or down accordingly. To sum it up, the prime rate is a key benchmark that affects the interest rates on HELOCs, home loans, and auto loans. When it moves, it changes how much you pay on your borrowing and how much banks earn. Keeping an eye on the prime rate can help you understand when borrowing might be more affordable or more costly.